Welcome to Investing in AI Startups with Stanford Angels and Entrepreneurs United. Our group connects the Stanford startup community and innovation centers across the country beyond California with regular remote programming and focused mixers. Thanks for joining us. I'm Sheila Proeve, a co-president of the group, partner at Prime Row Ventures, and a Stanford engineering alumna. We're delighted to welcome top minds in AI, Warren Packard, partner at the AI Fund, and Amit Garg, founder and partner at Tau Ventures. Note, this session is for educational purposes only and is not intended to constitute legal or financial advice to you in your specific situation. For such advice, please consult with your own legal, tax, financial, and other professional advisors. Welcome to guests Amit and Warren. Amit Garg is a founding partner at Tau Ventures. Amit's career spans from engineer to operator to top-tier VC. Before founding Tau, he invested at Norwest Venture Partners and Samsung Next Ventures. A former PM at Google and Stanford alum, he now leads Tau Ventures with a focus on AI-first startups in health, automation, and enterprise. With acquisitions of several portfolio companies, Tau has grown to 90 million assets under management. Amit brings over 25 years of sharp, hands-on insight into where AI has been and where it's headed next. We're also joined by Warren Packard, a partner at AI Fund. Warren brings decades of operating and investing experience. As managing director at DFJ, he backed icons such as Tesla, Yammer, and Box. He's also a serial entrepreneur with successful exits from Angera and Thuse Sports. With 3 Stanford degrees and his vantage point at AI Fund, an AI native venture studio, Warren brings a rare blend of insight into both building and backing the future of AI. Warren, how has your investment journey evolved in parallel with the rise of AI, and how is it shaping your future direction?
A great question. Obviously, AI is evolving extremely rapidly. And when I was at the helm of Thuse Sports, we were creating an AI native highlight reels platform so we could create personalized highlight reels. And so we were incorporating AI into our platform. So AI started off as a component of what we were doing. And now very clearly, AI is the core of what almost everyone is doing these days in terms of starting up companies. But then further to that, now we're seeing that AI can be a programming companion, and it certainly can be the programmer itself. And this whole evolution in AI, becoming more intelligent, becoming more interactive, more involved in the products, has really shaped startups and what they can do, the speed at which they can create their code and evolve and iterate their code, and even the fundamental architectures of these products. Given the hyper acceleration of technology that we're seeing these days, I expect that startups are going to evolve extremely rapidly. And of course, the investing that goes alongside these startups is going to evolve as well, extremely rapidly.
Thank you. Amit, how has your investment journey evolved, and where do you see it going forward?
Yeah, Sheila, first of all, thank you for organizing. Thank you, all of you, for being here. So AI is not a new word. AI as a concept, as a modern concept, has been with us for almost 70 years. We've gone through 2 nuclear winters, is the term in the industry. But what's different now than before is that we have a lot more data, we have a lot more computational power, we have models, and we have enough people who understand what AI is. So the combination of this has meant that things that we hope to do are now possible. Agentic, right? Agentic enterprise, agentic healthcare, having an agent that does tasks for you, whether it's programming tasks like Warren was mentioning, or whether it is reducing paperwork in healthcare, which is a huge problem in this country. All of those things are now possible. And it's not just a little bit, it's a huge difference. We're talking about 10x potential savings or even more when it comes to time, when it comes to cost, when it comes to efficiency. So I'm very excited. I've been waiting pretty much my whole life for this. When I studied at Stanford a few decades ago at this point, I did learn about AI, and I did do my master's also at Stanford, thinking about how you could apply AI to solve the problems that today are now solvable. And I'll give a very specific example. The very first investment we did through Tau Ventures specifically is a company that uses computer vision to detect colon cancer. It's a huge problem, cancer, right? Early detection is the key for early treatment. I'm simplifying things a little bit here, but this company called Iterative Health was able to go from the average of 75% detection to 99% detection by taking the video feed of the colonoscopy in real time, running it through their eye, and saying, hey, there's something here, go take a look. So instead of 75 people out of 100, 99 people out of 100 are now going to potentially get the right kind of medical advice. This is huge. Think about how many lives we can save. This particular company has now gone way beyond that. They're not just doing this for cancer, they're doing for all kinds of GI issues. And they're not only doing diagnostics, but they're doing treatment, they're clinical trial matches. They've raised $200 million. This is the excitement of AI.
Let's talk state of the market. AI Fund recently closed its second fund at 190 million, a standout raise in a tough market. What drove LP confidence, and what are you seeing inside the AI investing landscape now?
Yeah, I think it's an interesting story, how we raised our second fund, because in general, when venture capital funds go out to raise fund two, they're doing so at a time when they typically haven't generated any returns in fund one, or very minimal returns in fund one. And of course, in venture capital, usually you lose a few businesses fairly early. As we say, the lemons ripen early. And so you even are at a point in the J curve, if you will, where you might have a negative return for investors. We actually have a positive return on paper for our investors in our fund one. But whatever the case is, it is challenging to raise a fund two. Of course, there are tailwinds with AI because we're an AI-focused fund, and that certainly helps out a lot. But the main thing that we did, because we realized that we didn't have yet these big exits from fund one, because it's just a fund two, is we went out and we figured out that we basically sought product market fit. So just like we push all of our companies to get to product market fit, we had to push ourselves to get to product market fit. And our product is a venture studio. So we actually are co-founders in all the companies in which we invest. And that means that we're generating or attracting ideas and concepts and opportunities rather than trying to attract companies that are already formed or just newly formed. And then we thought about who has ideas and concepts to share, who shares in this strategic vision with us. And it turns out that corporations writ large across the globe are interested in jumping in on the AI race, and they really don't know how to do that. And so we approached corporations across the US, across the globe, and we said, look, why don't you partner with AI Fund and we'll co-build companies together. You've got great opportunities and ideas that are within your four walls. Your employees are incredibly creative. Many of those ideas are not strategic to you. Of course, the strategic ideas you're going to incubate and build internally. But for all those ideas and concepts that won't be built inside your four walls, let's build a business. And so that was the pitch that we went out to. And we were able to attract on the order of 15 corporations to come in and be our LPs for Fund 2. And this includes, of course, LPs that are continuing on from Fund 1. But our primary LP base is now a set of corporations that span many different industries across most of the corners of the globe. And we're now incorporating their ideas into startup companies and getting those going. And so it's a really nice product market fit in terms of what we're doing at a venture studio. And we were very fortunate to be able to raise $190 million. We just announced that. And we're in business, building businesses for the next 4 years or so until we have to polish off the documents and raise a fund 3.
Quick follow-up on that note, Warren. How did you make the mental and strategic shift from traditional VC at DFJ to launching startups internally?
Yeah, so I spent 13 years as a managing director of DFJ. I then started my own company, as I mentioned, through sports, and I ran that for 10 years. So I went from the venture world to the entrepreneurial world. And in fact, I had started a company prior to DFJ, so I guess I've been bouncing back and forth. But moving to a venture studio was a logical destination. It combines both venture capital and entrepreneurship. And this really reflects the managing general partner of AI Fund, Andrew Ng, who is really foundationally an entrepreneur. He founded Google Brain. He was the head of AI at Baidu. He founded Coursera. And through Coursera, he's taught millions of computer scientists the trade of machine learning. And so he's fundamentally an entrepreneur, but yet at the same time, he is eminently backable as a fund. And so if you put the two things together, you come up with a venture studio. And so I don't view it as like one could possibly view it as a compromise, if you will, between venture capital and entrepreneurship. We view it as a very interesting augmentation of entrepreneurship where we can actually build companies at a scale basis very rapidly using AI, of course. And we're now creating a company every month on average, so about 12 companies per year, and doing so in a scalable manner that we're looking forward to seeing those returns in the very near future.
Now, Amit, Tau Ventures has grown to 90 million assets under management with several exits. What's driven that performance, and how are you approaching this AI investment cycle different from prior ones, such as mobile or cloud?
Yeah, those are two questions, very good questions. So the first one, we are currently investing out of our fund two. We are towards the tail end of it. We have increased our check size from our fund one. So now these days we write 500Ks on average at the seed stage. And I know it gets a little tricky. What is seed exactly? I'm happy to go into that topic if it makes sense. We also have an opportunity fund, which we use to double down on the portfolio in the A, the B, or the C. And very opportunistically, if we see a deal we get excited about that we hadn't invested before, we can come into the A, the B, or the C through the opportunity fund. So that's the context. What we were investing in at the very beginning when we started 6 years ago, and what we're investing in right now, frankly, it actually hasn't changed. We were excited about applying AI to solve problems. So we're not investing in core AI. To me, core AI is the people who are building the tools. It's companies like OpenAI, Anthropic, and so on. And obviously the big platforms like Google and Microsoft. I'm investing in companies that take those tools and use it to solve the problems. For instance, Iterative Health, the example I was giving, they didn't build all the algorithms. They took existing tech stacks, they refined the algorithms, they adapted it. They took 20,000 videos from 40 hospitals to initially train the algorithm to be able to do a polyp detection to 99%. Those are the types of companies that we're excited about. And to tie in your second question, if you look at what happened with cloud and mobile, and even before that with .com, they become platforms eventually. And that's what's happening with AI right now. To us, AI is a horizontal, it's not a vertical. We're not investing in AI companies. Every company has AI to some degree. And in the near future, all companies will have to have AI because it makes your processes more efficient. So I'm excited about AI becoming this layer, just like cloud and mobile and .com websites have become platforms. So I expect a lot more companies to get created. As we continue building AI further and further, as the cost of AI comes down, just like for cloud and mobile also came down, more companies will get created and higher up in the stack. I specifically focus on digital health. So my partner focuses on enterprise. So I focus a lot around the paperwork. How do we reduce the $1.6 trillion that we spend in paperwork in this country, which is about 1/3 of our healthcare costs? It's crazy. Billing, payments, prior auth, benefits management, revenue cycle management, a lot of problems that many other companies have, but are particularly acute in healthcare. And the other side of our thesis is investing in things that affect many of us. Diabetes, obesity, mental health. How do you empower the patients to be able to manage their healthcare better? How do you empower providers, doctors, and nurses to be able to do better diagnostics? How do you empower pharma to be able to do research better, to produce the drugs that will save us? There's a lot of P's in healthcare. There's PBMs, there's policymakers, there's profit. I can expand that thesis if it's interesting, but I focus a lot in my investment thesis in understanding that, how the founders are able to use AI to tackle these problems.
Let's talk identifying opportunities. There's intense hype in AI right now. What niches or categories actually show lasting promise versus fleeting noise?
I think the hype is interesting because on the one hand, everybody's talking about it. It's on the tip of everybody's tongue. However, there's also a lot of negativity around AI at the same time. So maybe the hype is both ways because a lot of folks are like, wait, what has AI done for me today? I don't see the value in AI. Maybe they tried ChatGPT and hallucinated, or they had some other experience. And then there's a number of us who have had incredible experiences with AI, and we can very much see the power of AI today and where it's going in the future. But it's got this interesting mystique right now. I think there's a group that wants to speak it up and talk it up. There's a group that's very skeptical, and for good reason, because it's still very young and it does make mistakes and it doesn't live up to all the hype that's around there. But to speak to some of the trends, at least from a technology basis, Amit mentioned agents before. And so agentic AI, where you basically have individual language models that take on specific personas and pursue specific roles in concert with other LLMs that are playing different roles. So you can create an entire movie where one LLM is the producer, one's the director, one's the casting agent, one does set design. And you can actually see these LLMs interact with each other. So each of these agents acts almost as an employee, if you will. We're also looking at a trend in local AI, where you can fit an LLM and on your local computer and your local phone, your mobile phone. You're not resigned to using it in the cloud. So you're untethered from the cloud. You can get faster response. You can keep your data private. And that's a big trend. There's also a big trend in programming, I'd mentioned earlier, is the ability to leverage AI for creating all these amazing programs extremely rapidly. You can vibe code, as they say. You can just basically put in a prompt and say, I want this program to be created, and boom, it gets created within moments, and you can run a program. In fact, every single employee at AI Fund, we have about 22 employees, has learned to code, vibe code at least, and can create their own programs. And the final trend, technology trend I'll throw, and there's many technology trends, but is talking about as multimodal, is not just language models, but image models and audio models and video models, and basically being able to interface with AI through all the different senses and have multiple inputs, multiple outputs to service many different industries in many different ways. But I also I hasten to add before passing this along to Amit, that it's really important to recognize that it is about the problems that we're solving, real world problems. It's not about the technology itself. And so all of these trends in technology lend themselves to solving real world problems that we all have, whether as consumers or in our business lives or wherever. And that's where we start. And it sounded, based on his last answer, that sounds where he starts is you start with adding value to the world using and leveraging these technologies. We don't want to be building technology for technology's sake. We want to make the planet a better place.
Yeah, I couldn't agree more. And let me expand a little bit about what Warren was saying. There are a little bit of a bimodal distribution, two camps when you think about AI. There are companies that are making the headlines, that are raising massive amounts of money without having as much revenues because they have promise, they have potential. Many of them will fail or won't succeed as much. And that's okay. That is what our industry is. Venture capital startups. It's high risk, it's high reward. There's creative destruction going on at all times. If you think back about other bigger revolutions, whether you think about cloud or mobile or .com, or even before that, if you think about the PC revolution and other technology revolutions, you create a lot of companies. Some of them work out, many of them don't. And yes, you could argue there could be more efficiencies, but that's how innovation proceeds. Unexpected things will lead to unexpected outcomes. Some things that were obvious don't succeed. Some things that were not obvious do succeed. So I think that's why there's a dichotomy of reactions around AI, because some people see what is working and other people see why it's not working. But when you come to trends, I fully subscribe to everything Warren is saying. I'll point out the trend that I have been really focused on, which is that AI is making an impact into verticals that have been traditionally very resistant towards change. And I think that's great news for all of us. I focus specifically on healthcare, but if I think about beyond legal, GovTech, like honestly, sectors that are laggards, sectors that resist for many good reasons, they are, for many reasons, adopting these technologies at rates that we have never seen before. In the case of healthcare, because they have to. Our costs keep going up and we need more efficiencies. It's untenable the way things are. We don't have healthcare. My view is we have sick care. We take care of people when they get sick and we send them home. What we want is preventive healthcare, and we want this industry to be smaller. And I think AI provides that possibility. Now, let me just double click a little bit on the challenges for us to get there. AI today, there's challenges around privacy, and that matters for many industries. There's challenges around explainability. If we put in something into that black box, but we don't know how that black box came out with that answer, how does that work, right? Self-driving cars, a car hit someone, like how do you explain that? A doctor did a diagnostic based on AI and it turns out to be the wrong thing to do. How do you explain that? Hallucinations, which Warren mentioned, right? Coming up with the wrong advice. Like these are long-standing challenges. Liability. If AI says one thing, the human says one thing, where's the liability? Is it in the person who built AI or in the practitioner of the AI or the end user of that AI? We don't know those questions yet. These are decisions we'll have to make as a society. And it entails us as investors, as founders, as policymakers. It entails all of us to come together with the right answer.
I wanted to add a couple of things to what Amit just said, just to reinforce it. My wife's a physician, and it probably wasn't more than 9 months ago that she said, "What is this AI thing?" Of course, ChatGPT had been around for a while. I said, just use it. Just try it. Try ChatGPT, see how it works. Ask it a question, get an answer. And she used it and she was like, okay, this is interesting. It was a novelty to her. She went into her office probably a month later or 2 months later. She was offered a digital scribe. She has human scribes in the rooms with her when she sees patients who take notes for her and enter those into an electronic medical record. She was given the opportunity to try a digital scribe. Because she had toyed around with ChatGPT, she raised her hand. She said, sure, I'll volunteer to use a digital scribe. And again, to Amit's point, this is an industry that is usually a laggard in adoption of technology. My wife used this digital scribe. She was sold from the first moment. And while it was not perfect, it was significantly better than the human scribes that she was working with, just to be very candid. And even though it might make a mistake every now and then, I'll just make up some numbers, so I don't know what the actual numbers then are, but the AI scribe was 99% accurate, and her human scribe was 83% accurate. And that delta was absolutely significant for her. She has enjoyment of her job. She gets out of work earlier. Her notes are more accurate. And even though, and to the point about liability, one could say, hey, this AI is wrong 1% of the time. But the reality is that 1% of the time is so much better than what's going on right now. That is absolutely permissible. And the notes don't have anybody's life on the line. So I'm not talking about making life or death decisions here. But my wife embraced the digital scribe. She then could evangelize this to her colleagues. Now the entire office is on digital scribes. Now, of course, that brings up the other issue about what happened to the human scribes. But I'm going to pause for a moment and just leave it at that and saying that that industry adopted it very quickly.
So let's move to startup evaluation and defensibility. What early signals stand out consistently when you're evaluating an AI startup for investment?
Let me take a crack at this. I'm focused primarily at the seed stage. So let me define what seed is. It's not the amount of money you're raising. That's my view. Some people may disagree, but it's what you use the money for. If you are at the PowerPoint stage, you have nothing, a vision, that's a pre-seed. It's typically two people in a garage here in Silicon Valley or two people in a loft in New York. If you're one step beyond that, you have a minimal viable product. You may have even a pipeline. That's what a seed is. You're 9 to 18 months away from product market fit, which is the Series A. Typically, that has been defined as 1 million ARR, annual recurring revenue. That number changes a bit depending on where you are, what industry you are, but that's been the benchmark for a long time in the US. And then Series B is when your business model is really taking off. So I focus at that seed stage when people are going from not 0, 0.1, 0.2 to 1. And team is always the number one factor. I would argue even at the IPO stage, you're at the end of the day investing in people. Who are they? How do they connect? What is missing in this team? How well would they work with you? Do they have the confidence and the conviction that they can succeed, but also the humility to know that they can fail and the humility to ask the right set of questions and change their mind, right? It's a contradictory thing to keep in your head. So we pay a lot of attention to that. We're backing at the end of the day, people invest in people. That's the first T of Tau. The second T for us is technology. We are technologists of ourselves, and we pride ourselves on being able to understand how they're applying technology and building some kind of moat. At the end of the day, execution is the ultimate defensibility, but you can get a little bit of help by building or applying technology. So we look for some kind of that moat. Could be data, could be an application, could be trade secrets, like something that allows you to have more defensibility against incumbents and fast followers. And then the third T is traction. So we look for hints. We're not expecting revenues, but obviously if you have some revenues, great. We're looking for a pipeline. Show me that you can get to customers. If you're selling into a payer, fantastic. How do you escape the 2-year sales cycle? If you're selling into providers, do you have 2 or 3 of them lined up? If you're selling into self-insured employers, how did you get in and how can you get to more? Can you increase the contract size, the TCV and the ACV, total contract value, annual contract value? So we look for tea leaves here. And my co-founder likes to say that 1, you had a friend, 2, you got lucky, 3 shows a pattern. So if you have 3 or more in your pipeline, that's a good sign. So it's not a perfect science, which is why I think that AI is not going to take away my job anytime soon. It's going to augment my job. But at the seed stage, there's a lot of judgment and there's a lot of prospects. I look at 6,000 companies a year and I'm doing 12 investments, about 1 a month, because we want to make sure that what we invest in is a good fit for us and that we can help them.
Warren, from your perspective, what moats or models do you believe matter most as you're building these AI companies? Do you look at data, distribution, speed of iteration, or something else?
First of all, I'm going to echo what Amit said, that team is absolutely a moat. If you've got a great team, you're going to be able to do incredible things. You're going to be nimble. You're going to be smart. You're going to be able to execute. And I know that's not a business moat, because of course you're counting on your team to create business moats, but that's where you need to start with, is that team. Certainly data. And that's part of our strategy at AI Fund. By partnering with corporations, we are co-building companies with them, and they're bringing subject matter expertise. They're bringing channel access. They bring their problems to us that we solve together. But most importantly, they bring data. And so we have proprietary data access we can train our models on or do evals on. And that really helps that our companies really know that they're hitting the mark there. And then beyond that, execution. Again, it's not really a moat per se, but execution is all about being able to actually deliver on what you say, being incredibly nimble because the environment is changing, and adopting, embracing AI as your tool set so that you can rapidly develop your products. And then ultimately, if you can execute, you can grow your customer base, you'll ultimately get a reputation or a brand that's there. And that'll be something that will be able to help you quite a bit, because the first calls that corporations make to a new tool provider or service provider or whatever are to folks they already know. And so if you're delivering a service successfully to them, you can build on that. And that's of course what makes it very difficult to start a company, because you're not in their, I'm going to say the word Rolodex. They're not in your Rolodex, to throw out an old term. But in any event, you've got to find moats wherever you can find them. And one thing that I would say is not a moat is really AI technology, because you're going to use it. It'll be the core of your platform, but it's going to be something you're going to have to swap out on a regular basis in order to stay up with everybody else that's developing new products on new technologies. You've got to be at the cutting edge of AI. And so you're constantly swapping, like hot swapping your AI core in order to stay ahead. But there's definitely some moats that really exist there, and it all starts with team.
Now, on to funding and the exit environment. AI is one of the few sectors where capital is still flowing quite actively. What are you seeing in terms of deal velocity, investor selectivity, and round dynamics?
Yeah, that actually ties in with one of the questions that just came through. There's a lot of data on this, first of all. I encourage folks to look up Carta. They publish data on the different rounds, the sizes, the velocity of the deals. Fenwick here is a law firm in the Bay Area. They also publish quarterly state of venture capital and startups, and there's many more sources of data. So I do encourage people to have their own point of view on this. But from where I sit, it's a little bit of a bimodal distribution. And I would argue there's always been a bimodal distribution. There's a few startups that are able to raise massive amounts of money before having significant traction, perhaps based on the strength of the team, it's serial founders, or the strength of the vision. There are 19 Nobel laureates that started Alta Therapeutics and raised $1 billion. Those are the exceptions. They do make the headlines disproportionately, but that's not for the 99.9% of us. What I would argue is the average seed here in the Bay Area these days that I see is 3 to 4 million. That's what I tend to participate in. I would put 500K usually into those, and the valuations are usually 4 to 5x of that amount. That's the standard. It's a norm in the industry. It's not a rule. Some founders are able to pull off lower dilutions, some founders higher dilution. If you have hardware in your company, significant amount of hardware, then chances are that it's going to be a lower valuation. But by and large, I still see 3 months as the average for you to be able to fundraise. I tell all of our founders that plan for 1 month to get to a partnership meeting, plan for month 2 to get the term sheet, and plan for month 3 to be able to close the syndicate. If you're able to do it faster, great, but plan for 3 months. If it's taking you significantly longer than that, especially on step 1, then go back to the drawing board and figure out whether you need to change something about the style, what you're saying, about the substance, or about the strategy, who you're speaking to. I recommend, very tactically speaking, that founders build a spreadsheet, put 100 names on that spreadsheet, and divide them into 3 tiers based on the fit. And don't start with tier 1 unless you have conviction. Start with tier 2, test out your idea for a couple of weeks, your pitch for a couple of weeks, and then migrate to tier 1. Get warm intros as much as possible, or people who already have a relationship with you. In a world that's increasingly flat, where everybody has access to everybody, where knowledge is accessible to everyone, the social validation matters. If a deal comes to me through somebody I trust, I will pay a little bit more attention to it. I'll read everything that comes to me, but I'll pay a little bit more attention to it. And the last thing I would say is never, except for when you're raising your very first round, never run more than 6 months low of cash. You don't want to be hard pressed into accepting a deal. So if you're raising a Series A and you have 9 months of cash left, you should probably be raising the next round or figuring out a way of increasing your runway, reducing your burn, getting more revenues. There's many other ways of doing this.
Yeah, I'll add on top of that if you're executing as a company and executing well, you should be able to raise a round of financing. It's hard to raise a round of financing, but the venture community or the venture industry is not broken. And so if you're finding that it's taken a long time to raise, you may not have hit the milestones that are required to get to that next round. And Amit mentioned some statistics that like, what do seed investors look for? What do Series A investors look for? What do the Series B investors look for? And I would concur with what he was saying. Our companies that are looking for like we do the pre-seed financing, so it's typically $1 million check. And then anywhere from 6 to 9 months later, they're going out for their seed round. And it's incumbent upon our companies to have a nice selection of customers. If we're talking about like a B2B SaaS company, you're going to want 3 to 6 to 9 to 12 customers that are referenceable. The more, the better. And if you are generating revenue, which you should be at that time, you want to show that your revenue is going up and to the right. And of course, it's on a small number of companies, so it could be lumpy and all that, and that's fine. But you want to prove that you can sell your product to your ideal customer profile and that it's not just a mistake that a few companies, your friends, for instance, bought your product. You actually were selling to folks that were disinterested third parties, so to speak. They only bought based on the value of the software. And then after you raise your seed round, you want to be going after your Series A round with product market fit. And again, there's random metrics that can be used to say whether you're there. It could be a million, million and a half ARR, 2 million ARR, whatever the case is. What you ultimately want to show once you hit product market fit is that you can repeatedly grow your revenue at multiples. And there's someone else made up the triple, triple, double, 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 but it really works well. That let's just say that you've got that $2 million is your product market fit. From there, each year for the next 5 years, you want to triple, triple, double, double, double your revenue. You want to go 2 to 6 to 18 to 36 to 72 to 144. Good thing I can do my math still. But that kind of revenue growth, that is the characteristic trait of an extraordinary company. And you should be able to do that if you're an extraordinary company, and venture funds want to invest in extraordinary companies. So that's what it means to execute. That's just one metric, but it's a key metric.
As AI matures, are you starting to see more clarity on exit paths, whether through M&A, acquisitions, or IPO tracks?
I'm not going to sugarcoat this. The M&As and IPOs have been lower for 2 or 3 years now, especially IPOs. There's many reasons for this. Our expectation is that M&As at least are coming back slowly but surely. There's always acqui-hires. There's also this thing called reverse acqui-hire. It's a newer thing. It's been around for about a year as a word, at least. I'm happy to explain what that is. But people are getting more and more creative. You as a founder, though, can facilitate. I tell all of our founders, we have 80 companies right now, that acquisition is really the result of usually, almost always, of a long-term relationship that converts at the right time. Usually they're your customer or a partner, and they've known you for 1 or 2 years. And oftentimes it's because you're fundraising the next round, and it will get more expensive and will trigger an acquisition. They'll say, okay, you know what? We'll just buy you now because the next one will make it more expensive. It's called a dual track in the industry. So I do encourage some of our founders to say, you are at that right point, do a dual track, AKA put yourself out there for both an investment and an acquisition. They are separate but complementary conversations. There's also wisdom in hiring a banker. It's not for everyone, but there are different kinds of bankers who focus on small cap, medium cap, and large cap. I do encourage our portfolio companies, if they are not already connected to enough potential acquirers, to work with a banker. And they will usually take between 5 to 10% of the proceeds of the sale. Sometimes with a retainer, you can negotiate those things. But by and large, VC is a game of long term. I'm investing at the seed stage. Warren is investing at the pre-seed. We're not looking at flips. They happen. An exit happens within 1 or 2 years. But we're looking for people who are building for 10 years. We're looking for possibilities of 10x or more. So if you as a founder are building a business that you think could exit in 2 or 3 years, that's great. Don't come to VCs. Come to other sources of capital. There are sources of capital for you. In fact, I discourage actively people from coming to VCs. You should come to a VC when you're building a very specific type of company, the type of company that grows exponentially, that is thinking of being a huge company with 10x plus potential. And that's 1% of the companies in the US, which represent 50% of our stock market, but still it's a smaller number. There's many other ways of getting funding: family offices, corporates, grants, loans, your own revenues. So it's not the right model for everyone. That's my point with it.
Now, last question before we move to live Q&A. On founder readiness and support, what do startups actually need most from investors beyond capital?
Given our model, it's quite a bit that we're offering, and it is probably a good opportunity for me to give a very quick summary of how we work with ideas and how they get to become companies. And in very quick succession, we'll get an idea from a company, we'll spend about 4 weeks validating it to make sure it is venture scale, exactly to Amit's point. I mean, there's some great problems to be solved, but if they're not venture scale, it's not worth our time or effort. Once we validate it, we go into recruiting. My partner Linda runs talent for us, and we do this unnatural act of finding a founding CEO for our company, as opposed to the other way around. But I believe we've got the formula locked in for what characteristics work well for that CEO. But then we also hire a venture advisor. This will be the individual who becomes our board member. That board member is working very actively with the company when we go into the next phase, which is company building. And that's a 10-week process where we put together one of the business builders on my team, two technology builders, one for rapid prototyping, one for AI development, that venture advisor and the CEO. All five of those individuals work together for 10 weeks to prototype, rapid prototyping, product-led building, where we prototype the product, get it in front of customers, and iterate. Prototype, customer feedback, iterate. We do that 8 weeks in a row. And the demand is that we have a new prototype every 8 weeks. Now, this isn't a enterprise class type of prototype. This is a UI prototype that customers can use. But we're very much into getting customer feedback so that when we emerge from that build process, we know we know who the ideal customer profile is. We know what the product features are for that MVP, and we can go and finish up the MVP robustly, get it out in the market, and start generating that customer growth. From there, we hire the first 5 employees for the company. We continue to work with them on strategy. And then when they're ready to raise their seed round, we're very active in introducing venture funds, the right venture funds, the ones that, like for instance, if there's a digital health startup, we're going to go to Tau Ventures and introduce that company. But that's the value that we add. But ultimately, as much as we want to add tons of value to our companies, the reality is it comes back to that core team, that CEO, that initial team that is put into place. And we do have a big influence on that because we're part of that hiring process. But we really have to recognize that our influence is limited, and it's all about the team that's ultimately taking this forward to success.
I'll echo what Warren said. We're not the captains of the ship, but that's the team, the CEO specifically being the captain. But we're the first mates. We're there to help. Another analogy that I often use is you're playing a sport, soccer, basketball, whatever, favorite sport, and we're the coaches. If we do our job well, nobody knows about us. If we don't do our job well, people will know. But our goal is to make the players successful. And what that translates in reality is, for us at least, we leverage our community. We have built it over a lifetime. We have 1.6 million people now through all of our channels. If our companies are looking for more customers, we'll make intros. If they're looking for more investors, we'll make more intros. We have 5,000 VCs on our mailing list, so we have access to a lot of folks. If they need more hires, it's in many ways similar to what Warren is saying, except that it's at the next step and it's less hands-on than what Warren does, right? A venture studio, you're doing it very hands-on, 8-week sprints. We are doing it at the next step where they do still need help, but a little bit less, hopefully. And one of the key things we do is really push the companies to get to that product market fit, because that's when they get to the next step. Just like Warren is getting the companies to the next milestone, which is the seed, I'm focused on getting them to the next milestone, which is the Series A. How do you get product market fit? It's a lot about making sure you have enough money, you hire the right set of people with that money, and then you go out and get the customers. So that is at the very heart of it, what we focus on.
Now let's jump into live Q&A. We already have several here. First question, given the AI tool support for founders, do you see early raises getting much smaller with time?
Well, that's a good question. You would think so, right? You would think that because things are getting more efficient, you need less money. I think that's true. You need less and less money. Like back in the day, if you wanted to run a company on the cloud, you had to build your own cloud. So you needed the money to do that. Nowadays, using that analogy, you don't need to build your AI tools. There's plenty of them out there. However, the round sizes have kept going up because there's other things feeding into it. You're using the money for other things, not to mention there's this thing called inflation. I am not seeing the raises getting smaller. I'm actually been seeing a consistent trend for more than 2 decades here in the Valley that the raises have been getting larger. The good news is you can get away with less money for doing the core things. So this is a situation that's very common. You have raised a seed, you are thinking about the A, but you find out before or during the fundraising process that you're not quite getting there. And then the conversation becomes, let's do a seed extension so that we can actually prove those milestones and then raise the next round. I have this conversation with many of our portfolio companies, with many other founders who are not in our portfolio. And I ask the question, let's do the analysis here. Would having 1 million more get you to those milestones? You pay up a little bit in terms of time, effort, dilution, but you may be better positioned to raise an A. And you don't need a huge amount of money to be able to accomplish those milestones. So that's the good news overall. But I'll pass to Warren here.
Yeah, I would just, at our stage, at the pre-seed stage, we're definitely looking to invest less in that with that pre-seed check. And in fact, right now, it's our goal now to eventually get to the MVP by the end of the build phase. So right now we don't get there, and we have to still build some more after writing that pre-seed check. But we believe that tools very quickly will get our companies to the point where you can just get a robust enterprise class application out within a few weeks that's been cycle tested with users. And so that will require fewer dollars. But then also, to Amit's point, successful companies are able to raise more money to do more things. I'm not saying that the entire financing is necessarily going to be less, but certainly we're going to see the pre-seed financing from our standpoint come down, and us expecting more for that because of AI tools.
Now I'm going to lump these two together and pass them to you, Warren. So one question is, if you're mid-career, what recommendations do you have for such a person starting a company? And could you share some real stories, since you seem to be doing that very frequently? Also, are there particular challenges to the venture studio model that cause hesitation at later stage financing rounds by other VCs?
Yeah, taking the second question first, there's definitely going to be concerns from other VCs about AI fund owning too much of the cap table, owning too many common shares and preferred shares, because we're both a co-founder and an investor. And I need to make sure that when Amit sees our cap table, he looks at it and goes, okay, that seems reasonable. And that's critical. So we always view ourselves as a minor share, as a minor co-founder. We will always take a fraction of the shares that we give to that CEO. So even though we hire the CEO into the company, we're a fraction of their ownership. And then there's an employee pool, and there might be a co-founder, a full-time employee. It's something we think about all the time. It's known as killing the cap table. If we own too much of the cap table, and then the next round venture investors don't want to invest, they're like, there's not enough reward for those who are working full time. So we're very much aware of that. And I believe we do a good job of creating a good cap table. Regarding mid-career, I think without a doubt, in fact, whether you're early career, mid-career, late career, just embrace AI. Use the tools that are out there, use them in your daily life, use them for whatever, for family planning, to make your family planning better. Code up, do some vibe coding and get an app up. If you've got kids, work with your kids on AI. I think it's insanity that schools say, don't use AI for your homework. I don't want to have them be cheating here, but it's like, you need to be using AI. This is our future. But in any event, for somebody mid-career, embrace AI, and you'll see the power of that. And you'll find out that you can start a company very quickly. And if you're passionate about something in addition to your family, go ahead and start it. There's never a bad time to get going with an idea that you're passionate about and pursuing it.
Now, Warren, a related question, would your venture studio back, say, an AI B2B SaaS, which is not incubated internally?
Typically, we don't. So we do want to start from zero. And there's a lot of, Amit went through some of the other funding sources that are out there, but there's angel investors, there's pre-seed funds. And of course, I'm sure Amit would love to see great ventures just getting off the ground and provide seed financing. Whether you get pre-seed or seed, again, it doesn't really, it's just semantics. But us in particular, we're trying to collect ideas and opportunities rather than funding companies. So we're in a slightly different part of the ecosystem.
So moving up the chain, Amit, you mentioned seed rounds around 3 to 4 million, Tao leading usually with 500K. So that means others are syndicated together.
Yeah, so let me clarify. I see the question here. We're not leading. We're usually number 2 or number 3. Typically, the lead is somebody putting in about half of the round. So let's say you're raising 4 million, the lead will put in 2. I've seen 40 to 60 on average, so 50 is the median. The definition of a lead is not the amount, though. It's they are setting the terms. Typically, whoever is setting the terms is putting half of the round. There are some exceptions to this. And yes, seed stage is all about collaboration. It's very rare. I actually haven't seen in my career yet. Actually, no, I have seen a handful of cases where the entire seed was taken up by someone. Seed is high risk. So you want other good people in the deal. If fund will actively reach out to other funds and say, hey, I'm doing the deal, come along. We do this all the time on both sides. It's often that you build a syndicate with a lead taking 50%, a couple of follows, and then you fill up the rest with angels. You don't want too many chefs or cooks in the kitchen. You don't want too large of a syndicate, but you also don't want too small. If you have too small, you're not getting all the right kind of help. If you have too large, then the incentive for everybody to really be helping you is lower because nobody has enough ownership. These are things that you can obviously ask when you're talking to an investor. And I encourage every founder to spend 1 minute on somebody's website, 1 minute typing up the firm that you're talking to and the person you're talking to on ChatGPT to understand what their investment philosophy is like, and then talk to them and ask questions to clarify so that you understand the lens at which your investor is coming from, how much ownership they want, how much follow-on capital will they have, what their strategy is for the next round, do they want pro rata rights, etc.
So we have a few questions around building moats and particular investable segments. Amit or Warren, if you'd like to answer those. One is, how can newer companies build moats given competition with the tech giants around data and infrastructure? And then beyond the core LLM, what are investable segments that look promising?
I'll give a summary on both. So we did talk a bit about moats before, but the key is for entrepreneurs to realize what their advantages are. And their advantages are absolutely on speed to market and ability to iterate. If you can get in front of customers and iterate incredibly quickly, make decisions quickly, you can outrun larger companies without a doubt. And you're going to have to do it without the data, without the relationships, without the channel, without the money, but you can. There's I don't know if this is a competition per se, but let's just call it as such, that who's going to be the first one-person unicorn, the one-person company that can get to $1 billion of value. And I think that's a real thing, is that I'm not encouraging people to not have partners. I think a team of one you can't avoid groupthink. You need at least a team of two, but let's just say team of one making it to unicorn status, that would be amazing. And it's possible because you can move so fast. So don't worry about the disadvantages. Just not worry, but have fun with the opportunity that you want to pursue and just go for it. And yeah, don't worry about incumbents. I'll pass along to Amit from there.
That quote of the one person getting to $1 billion, I think it was Sam Altman who said that. It's likely going to happen in the near future. It's not even far future.
Yeah.
Because of the efficiencies we're getting. But I do maintain, it may not be one person by themselves. They have a bunch of agents. They have maybe an outsourced team, contractors, et cetera, et cetera. It's a team of one on the cap table, but a much larger expanded team. But I'll just apply this on the domain of healthcare. And then also tie in with one of the questions around B2C that somebody posted. So when I think about healthcare, let's use drug discovery as an example. We know far less about the universe of molecules that can exist. The universe is like 100 times bigger than what we actually know. There's so much more to be done, and we just can't do them in a wet lab. If you can do it in silico, meaning on a computer, you can actually design experiments. You actually design and test peptides and come up with vaccines and come up with cures. That's happening as we speak. I think we've hit the garage moment, meaning that two people in a garage can come up with it versus the traditional model in pharma, which is 10 years and $1 billion. We don't have a drug that has been developed fully using AI yet in the market. It's a matter of time. But that to me is the promise of AI, for us to be able to do that. And when you talk about B2C, which is a different question that somebody raised here, yes, absolutely. B2C companies are going to use AI. I'm going to use an example here. We have a company called Signos, which leverages a CGM, a continuous glucose monitor. They don't make the CGM, somebody else does. And they take the data and understand what happens when you eat, drink, exercise, or sleep, give you insights. you can take better decisions. These guys got to hundreds of thousands of users with no marketing. They went directly to consumers first because it's a problem that many of us are attuned to, right? We want to lose weight, we want to be healthier. Eventually, they're making the pivot into B2B2C, which is going through providers, going through doctors, but they got to a Series B with that business model. We see that a fair bit in my investment thesis, where companies will start with consumers and then eventually expand. I can just imagine that there's examples like that in other verticals also.
Now, your final thoughts, Warren, if you're a Stanford founder building in AI today, what would you be focusing on or avoiding over the next 12 to 18 months?
I'd definitely be focused on staying up with what the state of the art is in AI and staying informed with all the new tools coming out on a regular basis. And of course, that can be a full-time job, and then you'll never get to the job of building a company. But definitely start off with a passion. And so I guess I've repeated that a couple times here, but it bears repeating. Just do what excites you, solve a problem, build a solution that has some real power. Doesn't have to be a venture scale opportunity, but build something that you really want to and you believe will add value to everybody else. And then you'll be successful, whether you're building to a unicorn or just a couple $1 million in sales, or even less. It could be a nonprofit as well.
Thanks. Amit, as an investor, what should you focus on and avoid over the next 12 to 18 months? Your final thoughts.
I focus on things I understand. There's plenty of things out there that I don't understand that are actually really good investments. I'm not doing them. I have the luxury of being in a place where we can choose what to invest in, where to spend our time. So the bigger message I have for founders is just because a VC said no doesn't mean that you don't have a good company. It means that it's not a fit for that VC. Different VCs have different theses because we live in a very matured, capital-rich ecosystem. If you compare the US venture capital to other countries, like we are very developed here, and there's VCs with very specific focuses. So the short answer to your question, Sheila, is that I'm going to focus on the things that I've been doing, that I will continue doing. I'm focused on agentic healthcare, billing software, payments, etc. I will focus on diabetes, obesity, chronic diseases, cancer. I have a dream here that we will transform most types of cancer into manageable chronic diseases in the next 10 years. I would love to be a part of that solution. I want to invest in things that do good and do well. I think we can choose to make our money in many ways. So I'm choosing to do it in this way, where I also get to make a good impact into the world.
Thanks very much, Amit Garg from Tau Ventures and Warren Packard from AI Fund for joining today. We greatly appreciate your time and perspectives. Thank you.
Thank you.
Thank you.